Hello again, this is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is Thursday, September 3rd, 2020. There's a lot to discuss today in our daily update, and thanks for watching. We appreciate it. We have over 1,000 subscribers on our YouTube channel, so we continue to ask you, thank you for our audience out there, and thanks for sharing and liking and subscribing on all our social media platforms. Continue to do so as we continue to report what markets are paying attention to and what really matters as it relates to our investment portfolios. So thanks for watching, and let's get right down to the headlines of the day. So right out of the gate today, we have markets selling off around the 3.5% range. If you're looking at the NASDAQ, you're about a 4 to 5% range as the moment in time that I'm filming this daily update for you. So we have markets pulling back. This is tech led. But the question is, Rob, is this something larger? Will this turn into something larger? Well, the reality is it doesn't appear so. And let me give you the reason why. We look at the market internals, the underlying, just not what the market says in terms of a sell-off and the percentage. We look at where the money is going. So we see the money is being pulled out of tech, but it's rotating internally into the laggards. So the leaders are taking a break right now, right? Think technology. Technology has been up 20% in the last, 45, 60 days, plus or minus. So for them to take a step back right now, that's actually healthy because the leaders have to wait for the laggards, financials and energy to catch a bid and catch up. Remember, if you followed me back in May, I discussed this earlier. We saw this once again. And the analogy I use is if like the Schein family, we have 4 children in our family, my wife and I. And so if we were to, take a hike, a daily hike up a mountain right now, my kids think they're, younger, faster, and stronger. They're the technology sectors, if you will. They're going to lead. They're going to run up way ahead of mom and dad, specifically dad, on their way up to the mountain. So they're going to run up, but they're going to wait or have to come back a little bit because I am, let's say, a financial sector or the energy sector. I'm slower moving. I'm sort of a value versus a growth play. So I have to play catch up to catch up to them because I'm not so quick and fast as I once was, even though in my mind I am, but to catch up to my kids. So that's what we're seeing right now as markets are consolidating internally. That money's moving out of tech and going into, leading sector, going into a lagging sector and bringing that back up. That consolidation is normal and healthy. So we want to watch on a go-forward basis. A couple key notes is that the moving averages, as long as those indices don't break the 20-day and the 50-day and the 200-day moving averages, usually it's the 50-day and the 200-day that we watch, that then leads to something larger or more concerning. But in the meantime, this is a normal, healthy sector rotation, consolidation that we're seeing within, and the money is moving within sort of different sectors of the market. In larger picture, let's take a step back from the equity markets, because equity markets are the sideshow. If you're really professional in terms of money management, like we are at Blanke Schein Wealth Management or those on Wall Street, you don't look at the equity markets, you look at the fixed income markets, because that really tells you the whole story. Right now, we're looking at the credit spread specifically in the junk markets. So think junk or high yield, and those are still tight, meaning they're not blowing out or not creating a sort of or signaling distress, right? So that's one of the key things that we look at when we see sell-offs in the market or sell-offs in every other category, right? Is everything else being sold all at one time? Is everything red? That means that that's a bigger problem. Right now, we're seeing sector rotation. We're seeing money rotate within from the leaders to the laggards, and we're also seeing credit spreads intact. So right now, we're in a good spot. Consolidation's healthy. And we forecasted this. If you've watched some of my daily updates, this is not unexpected. In fact, we've discussed this several times that we were waiting for something like this to happen, because then on a go-forward basis, this isn't a 1 or 2 day thing. It could be a couple of weeks going forward as volatility rises and uncertainty creeps in. And the uncertainty has come from Congress, right? Congress went from having a CARES 2.0 Act to going on recess. You could call it vacation. I call it vacation, they call it recess, and then they got back to emergencyly get in session to discuss the Postal Service. Remember, that was a couple of Friday and Monday. That was the most pressing thing for Congress to discuss, was the Postal Service as it relates to voter integrity, as it relates to the United States of America. But they completely forgot about those that are unemployed, right? We got a labor market that's healing right now, labor participation and a few other things. Have quality update today. Tomorrow is going to be all eyes on the labor numbers, the unemployment rate, if you will. Last we had read was 10.2%. We expect that to drop below the double digit number. So hopefully we get into the 9.5. I think that's what Wall Street's expecting, about a 9.5% unemployment rate. But that in itself is still bad, right? We have close to 10% of Americans that are unemployed. We have small businesses that ultimately can't open or reopen or are failing, right? And you have those that can't even get to school or have their kids in school, because that's a whole nother, I'm not going to talk about that because I got 4 kids at home right now, and that's a big important issue to me. Schools need to reopen in a healthy and safe fashion. But bigger problems, Congress just hasn't look towards the CARES 2.0 Act, right? It was supposed to be a large one. Now it's going to be a skinny version, more targeted to help the unemployed, to help the small businesses. That has to happen. Markets are selling off in anticipation of that sort of being a smaller deal than originally broadcast or even signaled, right? And so that's another thing that markets are paying attention to, and they will continue to do, because that's fully expected by market standards. It's already priced in that we're going to get help from Congress. But as economic information gets better, and as time, right, there's a time premium here, as time wears on, the patience wears thin. And ultimately the real economy, there's things happening in the real economy that's deteriorating, right? So that's a big challenge that we will see playing out. Congress needs to get back in session and get back to work, very specifically for the American people, because there are some very specific issues that need to be addressed. Okay, and there's another update on vaccines. Last 48 hours, we got news from the CDC as well as the FDA that they're going to fast track the third trial of one of the major pharma's vaccines, that they could literally have it ready to go late October, early November, and have a vaccine deployed in the United States. And that's going to cause a whole nother subset of problems, because raise your hand if you're going to be the first one to sign up for that vaccine. That's what I thought. So that's going to be the next issue that Wall Street's going to pay attention to. That's going to be an issue. You're going to have this rush to market, and you're going to have this vaccine, and markets going to be like, okay, great. There's a relief rally because we're all excited. And then you're going to have a participation rate in the vaccine that's going to be minimal at best. So then we're going to have another fight. I'm just forecasting, and this is my own conjecture, so it's my opinion. We potentially could see governments come in and mandate this. This could be another fight on our hands. So this is not something that we're out of the woods right now. One thing we are certain about is the markets are taking a breather. It's going to digest a lot. They've come a lot. I mean, markets are now at all-time record highs, so it's okay to take a breather. And state by state around the United States, the economy is opening. And another important factor that we're paying attention to is the trade numbers right now. We're importing more than we're exporting. And some of the headlines in Wall Street are like, oh, well, the trade numbers are not working in our favor right now. Well, think about that. The rest of the world is ahead of us in the coronavirus. Therefore, they've reopened before us. Therefore, their manufacturing has gotten back to work, and their exporting has gotten back to work. So they are working again. We are still in the able and willing category, right? Are we able? Like in California, we're not even half open. So we can't even, if we wanted to, go back to work in some specific sectors of the economy. So they're not able. And then willing, if you are opening, if a business is opening, is that person really, really willing to go back to work and be in harm's way as it relates to the coronavirus? Because this is a very important issue. So there's the willing and able labor force participation issue here in the United States. But you empirically look at the evidence of economies around the world, outside how we handle it as policymakers, right or wrong. The rest of the world has reopened. The rest of the world is manufacturing. The rest of the world is producing. We are consuming. Therefore, our trade is imbalanced right now, because what we're producing, we're not cranked. The factories aren't cranked up fully yet. So we can't produce to then have our trade be balanced, or our exports to be right back to where they were back in February. So you got to be careful about the headlines as it relates to the trade reports that we're seeing right now, because again, we're suspended animation, and we also have a labor force participation of able and willing. That's going to play out for years, as I just discussed. So we're going to have to see how this works. But the trade numbers are going to be a little bit misrepresenting. But also very important as it relates to watch what other countries are doing outside the United States and our policymakers. It just shows that there's empirical evidence that the rest of the world is reopening as we sit in suspended animation. I'm going to talk more about that. I am using that in my client calls. Clients really like that in terms of they understand the suspended animation, meaning everyone take a time out while the rest of the world works. Wait a minute, we got to play catch up. And that's the key to an economy and capitalism in itself, because then if you see your competitor, again, another country or another sort of small business in your sector, and they're really putting the work in and they're really trying to grab market share right now, then that's going to unleash the capitalistic society and the animal spirits. And that will come back. That's why we're big believers in long-term asset class like the equity markets. So don't ever bet against America, and don't ever bet against that aspect as to the American ingenuity and the American drive and spirit. So we're big believers in that as we get on this Labor Day weekend coming up. Thanks for watching. I appreciate it. Until next time, stay healthy and safe.